Good afternoon, and thanks for joining us again. Following on from our small cap roundtable discussion just there, we're joined again by Dan Whitestone from the BlackRock Throgmorton Trust. So just a quick reminder, again, that you can put questions through on the right-hand side of your screen, and please keep them coming, and we'll look to put those to Dan a little bit later on. So Throgmorton, I think it's fair to say, had a pretty successful 2020, but maybe not too surprising. It's now got the best 5-year share price performance in the AIC peer group as of today. Dan can take long and short positions in companies, and I think he's going to touch on just now. And I think it's quite fair to say he has some strident views on where opportunities lie right now. So to tell us more about the portfolio, I'm going to pass over to Dan.
Afternoon, everyone. Thanks so much for joining and for your interest. Hopefully I can operate these slides. So for those of you know this trust, and our owners, then obviously thank you very much for your support. And for those that are new, then welcome. And I hope that you find the next half an hour or so of interest. Okay, Throgmorton. God, I hate slides. One of the reasons I hate slides is I can never operate them. Nothing seems to be working. Good news is I don't need them. Right, let me tell you an overview of this trust. It is unlike any other trust I've come across yet on the market. The first thing to tell you is that it's primarily exposed to the world of like UK small mid-cap companies, and hopefully you heard the passion and conviction I have in that universe in the previous panel discussion. It's not where it ends. I could also invest up to 15% of the trust's gross assets in shares not in the UK. So I have many shares in the US, some in Europe, and a phenomenal company in Australia. So 15% beyond the shores of the UK. And I'm not a forced seller of my most successful investments that end up graduating to the FTSE 100. So I can actually keep some of those shares for another 12 months once they go into the FTSE 100. I don't have to sell them on day one. It has a gross of 130%, and what that means is that most trusts or funds reach your 100%. Some have a small bit of gearing; they can be maybe 110%. But Throgmorton's gross is 130. So for every pound that most people can invest, I can invest £1.30, which means I can magnify my returns, which hopefully is a good thing. If you think I'm a good allocator of capital and we have a good process and philosophy, we can magnify the returns. But make no mistake, poor analysis or sudden change in the market means that we can obviously amplify losses too. So something for you to bear in mind. The growth is achieved through a combination of physical shares and through owning contract for differences. And we can short shares, which is another key differentiator. We don't just make money from shares that go up, which is obviously what we like to do, find lots of companies that can go up lots and lots and lots. But we like to find companies that can fall a lot. And we've had many companies that have gone bust, and we believe there'll be many companies that will go bust in the future. And we do like to enhance the alpha we generate through the use of the short book. And one other advantage of the short book is it does help us smooth out the volatility of returns per cycle, because I'm a massive believer in the long-term attractions of small mid-caps, but over time it can exhibit more volatility than large caps. And so being able to flex one's exposure through the cycle is helpful. I mean, you know, we went into 2020 and the short book did phenomenally well. And we took the decision, brave it was at the time, but to close down many of those shorts in late March, early April, taking that up, but also crystallizing and banking those profits. And so the short book was a major contributor to alpha to the trust last year. And now we've been running with a net of around 120% for the last year or so, reflecting A, the stock market had fallen off, and we thought the stock market would recover. Two, we saw huge potential in our long book, and really expressing our conviction in some of the trends that we can see underway, which I'll talk about during this presentation. If I could actually show one slide, which this thing will not work, but if I could show one slide, it will be to show you the strength of this universe. Okay, I'm going to give up on this presentation. Sorry about that. The only slide I like to point people to is a slide that goes back to 1955, which shows you £100 invested in UK small caps and £100 invested in the FTSE 100. And ultimately, as you probably predicted, the £100 line goes like this in small caps, and the FTSE 100 goes like this, and it's a multiple. I've forgotten how many multiples, but it's an incredible period of outperformance. The trust since I've run it has delivered over 8% relative compound outperformance after fees. So I like to believe that we have outperformed an outperforming asset class. Here you go. Thanks so much. Someone has come to my rescue in my time of need to show you the very graph that I was talking about, and you can see the phenomenal difference in return. So ultimately, this is a great space, as a panel were agreeing. And my job, I think, is not to convince you of that, because I think that is an easy one to argue. My job is to convince you why you should give me your hard-earned money, as opposed to one of the other many good, active, small mid-cap managers out there. But before I do that, I just want to give you another reason why this universe is so successful. It's because, number one, it's diverse. I get so frustrated at everyone talking about like 20 companies in the FTSE 100, which is so not reflective of the many trends taking place in the 1,600 companies not in the FTSE 100 company. It's diverse and it keeps changing. Very few companies are the same. There's so much idiosyncratic, single stop specific risk. The second thing is that the dispersion return is really, really high. The rewards of success for winners are huge. Companies can multiply, other companies can go bust. And so this is not an index to me, an universe to me, where you'd want to buy an ETF, okay? You want to do the fundamental work and own the winners and absolutely avoid the losers to really benefit from that huge dispersion of returns that you can see in the universe. And the universe keeps changing. Every year, companies are acquired, companies go bust, companies, the AIM's not for them, certainly in the case of AIM, and many new companies come in. So it's a constant source of change, of new ideas, which means there's never a dull moment. It's massively under-researched. It's 1,600 companies, but every year most bulge bracket banks have retrenched further and further from the world of UK small mid-cap research. So when you combine a dynamic company doing something differentiated, something special, something disruptive in a large fragmented market, trying to take market share, the range of outcomes for revenues and profits and cash flow can be wildly different versus budget and wildly different to consensus forecasts. When you combine, though, that large range of financial outcomes with very limited research coverage, it can lead to not only huge moves in earnings, but huge moves in share prices, positively and negatively. And that's where having this team of 5 of us that I run here is really powerful. Work on the BlackRock platform, leveraging other teams, other insights, other experts in BlackRock, but also having that fantastic access to companies, and more importantly, having the internal research capability to do our own work, to do our own analysis and form our own insights on shares, and not be having to rely on the sell side to tell us how to think. We're quite capable and proud that we actually think for ourselves. If we move on to the next slide, probably the second most important slide, philosophy. The most important slide, I think, is the opportunity set of small mid caps and the outperformance. The second thing is ultimately why this trust. If you're not comfortable, I have to tell you that's totally cool, and I respect that opinion. I always tell clients this. This won't be for everyone, but this is what I believe in, and this is all up to me that really matters. And I won't deviate from this. So I don't own a single resources company. I don't own any oil companies, no mining companies. These are big parts of the index, okay? If you want that, you won't find it in this trust. I'm not interested in buying companies with weak market positions, with no pricing power, with the wrong balance sheet, with management teams that sort of lie under promise and don't live up. I'm not interested in buying the reflationary trade just to buy a company just because it's performed so badly in 2020 and hope that it may go up. I don't believe that just because a company's on 5 times earnings means it's cheap. That is not me. It never will be, and that's very important you understand this, because don't ask me to change if you buy into this trust, and know full well that there are periods, therefore, where my style and philosophy will be tested. And obviously, a most recent period would be ever since the vaccine. Now, the great news is that the trust is comfortably ahead of its benchmark and was still doing well in absolute terms and, more importantly, in relative terms too. But it has been a difficult period style-wise, which really is a testament to the strength of the business models and the secular trends that many of my companies are exposed to, that despite all of that, we've come out in a great place. But what I believe is that if you own differentiated, advantaged companies doing something special, changing the world, opening up new markets, or taking huge market shares in fragmented markets, or disrupting an incumbent industry, then the reward of success can be huge. And that is a simple belief. And the stock market, in my view, persistently undervalues these companies. It's constantly dismissing these companies as being too expensive. Oh, it's on 25 times earnings. It must be expensive and it's gone up a lot. Let's go out and buy this company over here on 9 times earnings. Not getting into the weeds as to why one company can actually be incredibly cheap on 25 times earnings, their capital light growth model that generates a lot of cash flow, versus some other company, revenues are going backwards, comes underinvested, wrong balance sheet, poor cash flow. And that is what drives my belief. And so I'm only interested in 2 types of companies. Companies that I think have certain characteristics that lead to long-term compound success. And when you compare great companies that have gone up many, many, many times in different industries, they generally have the same following things in common, which I'll come to in a minute. And the second type, which is not completely distinct, there's obviously a huge Venn diagram here where these 2 areas like intersect and overlap, which is ultimately owning companies that are driving or benefit from huge industry change. This is very important to me. I spent 4 years working as a strategy consultant before I went to the stock market. I'm a huge part of my belief is that power industry change is accelerating as the years go by, and there are huge rewards to be gained and huge losses to be avoided as the shifting tectonic plates move across industries. But the key things that we really care about that unite these successful companies are generally the following. Number one, management team, the thing that's so often overlooked, and the hardest thing to put in a spreadsheet, and the hardest thing to really, work out where that sits in the price earnings ratio. But ultimately, I'm a big believer in owning great management teams that have great visions and have built the depth and breadth of resource beneath them to execute on that vision. And they set the culture and the pace and the beating heart of the company. They don't get delusions of grandeur. They know what they're doing and they execute successfully again and again and again. Product strength, generally reflected in high gross margin, generally reflected in companies that spend a lot of percentage of sales and research and development, where you can see sales in a given year, a large percentage coming from new products that have been developed in recent years. So you can see they keep on investing and investing that money wisely and generating more and more sales because they've been coming out with better widgets or widgets with enhanced features and constantly solving customer problems. And that is what we like, solving customer problems or having something that people can't get elsewhere and they really want and they're prepared to pay for. And that generally comes through in high gross margin. So product strength, pricing power. The third thing is great company, great product. If you can get that in a fast growing, structurally growing market, you are in a good place. Like you can have the first two. If you're in a difficult market, constantly being interfered with regulation or irrational low cost competition or changing consumer behavior, it can really undo a lot of very good work. There are exceptions, but generally 9 times out of 10, industry will win. If you get the good product in a secular, structural growing area, it can do fantastic things year after year, particularly when you combine my last 2 things, which are all around financial strength. I like companies to be well invested and generally to have very strong balance sheets. I don't like companies that have lots of debt, because if anything changes in the world, it could be a virus, could be new competition, could be deferral of orders. You don't want to have a profit warning and marry that with a balance sheet problem. So I like well-capitalized companies because I know it means they're totally in control of their own destiny and they do the right things for shareholders in the long term. I really want, as I mentioned on the panel, the one singular metric is around free cash flow. I want my companies to generate a very high percentage of their earnings, adjusted or statutory, into cash. And it tells me that the profits and earnings are real. Much better off owning a company with growth on 25 times earnings, where the earnings are real and translate into cash flow, than you are in a company on 10 times adjusted earnings with no cash flow behind it. 100%. They're the things that we want. That's what we look for in our companies, and they are the unifying characteristics that have driven the success of so many of my investments and will drive the success of so many of my investments going forward. And that's all the fund that believes in. And as a result of that, I'm much more biased towards certain areas: consumer services, consumer goods, light industrials, specialist financials, technology, and profitable healthcare. And to repeat, no oil shares in the fund, no mining shares in the fund. These are parts of the market where other people are much more skilled than me in finding these shares, but they don't have the characteristics I look for. I don't have the skill set or the information ratio to take advantage, and I just ultimately see much better sources of your capital to generate long-term rewards and returns for you. And that ultimately builds a portfolio, and the net of the fund changes through time based on view on the markets, conviction in the shares. And I'll tell you, at the moment, the net is around 120. The gross is a bit higher than that. And we are as excited as we've ever been on the opportunity set. I said that on the panel earlier. I've been writing it in my monthly communications to you that are published on the portfolio updates each month, and I shall repeat it now. And I know I've said some of this earlier on, but let's just go through why I am excited, because ultimately you should always be excited when you're invested in this space. I'm going to go over some of the things from earlier. So number one, secular growth. A big driver of shares that we've looked for in the past have been companies that are exposed to long-term secular trends. And in many of these cases, I think in every case, it has accelerated through 2020, but much more importantly, will lead to, I think, an increase in the compound growth rate in the next few years, which ultimately, what I'm telling you is I think that's a much better prognosis for the revenue outlook over the next 1 to 5 years than it was pre-COVID. And so the outlook for revenue growth from here for many of my companies, I think, has dramatically improved. This is not a case of like a pull forward and a difficult comp, which you lap in 21 versus 2020. And, to repeat, digital payments, we're in the foothills. Cloud communications, we're in the foothills. Digital transformation in its broadest aggregate level, we are in the foothills and one of the fastest growing areas of GDP. Don't take my word for it. If you just print off the transcript from the CEO of Microsoft on their quarterly results, or Alphabet, or Salesforce, or Shopify, listen to what they're telling you. They're telling you that the outlook of digital transformation is as compelling as it's ever been, and is accelerating. If you take Jamie Dimon, the CEO of JP Morgan, his biggest strategic priority, digital transformation, he wants to go faster and harder. It is the number one item on the agenda for C-suites across every industry. They want to embrace, they've seen the benefits, particularly through COVID, of the costs and complexity that can be removed from digital transformation, and more importantly, the growth it can generate for many enterprise and B2C companies. It's such a powerful trend, and we are in the foothills. I think of like Gamma Communications in the UK. They've been driving upgrade after upgrade for a number of years, principally as the original model was really around replacing copper lines in telephony into a small medium enterprise, and replacing that with voice over internet protocol. Okay, so just think like analog digital. And then they worked out a few years ago that ultimately the big exchange, which is called the PBX, was physical, and the PBX was exchange was moving to the cloud. And so the latter part of the last 2.5 years has been generating more growth. They're still doing the copper to internet, but they're also now replacing physical exchanges with the cloud. We're in the foothills. Okay, like to put into context, cloud penetration rates in the UK are around 8.5%. In Europe, less than 2%. Gamma's profits today are around 80 odd million pounds, depending on which year you look at, of which 10 of which come from Europe. And those European profits have basically grown from 0 to 10 in the last couple of years. Their ambition is to turn Europe into a £100 million business versus the group profits today of 85. So the ambition is clear. The runway of growth is clear. the world is moving to the cloud, and penetration rates are still incredibly low. And this company is at the forefront of that transition. And when you can buy companies like that have a dominant position exposed to a really exciting long-term trend, and it can finance that growth, it's incredibly powerful. And I think the prospects for this company are particularly attractive in the years to come. And you can see in my top 10, which has helpfully been put up, that Gamma's my biggest holding. This is at the end of May, so some of these shares have moved since then, but Gamma's my biggest holding. You look at impact asset management, at the forefront of ESG, which is obviously rising up the agenda, has been delivering upgrade after upgrade after upgrade. I mean, phenomenal performance, great business model, absolute DNA is what they believe in, and quite rightly the clients are buying it, and the flows into that company have been incredibly strong. Electric components I mentioned to you earlier on, which is an example of this other big trend happening right now, which is around corporate Darwinism. And I'll be brief on this because I didn't mention it on the panel, but ultimately it's another industry where you have seen an acceleration of market share shifts through 2020, which electric components have capitalised. They raised money proactively in December, which we gave them money. We were a big part of that raise to make two acquisitions, to really solidify their market position, and these have both proved to be incredibly successful. But ultimately, it's a network business, and they found that many of their customers who basically run, manufacturing plants, when a widget goes down in a machine, the cost of that individual widget is very, very low, but the cost of downtime of a production line can be incredibly high, and so you need that replacement part, you need it as quickly as possible. And historically, what we've learned is that through 2020, many of the traditional suppliers to these manufacturing plants couldn't service that or deliver that specific widget because their business has been impacted by COVID, maybe they were closed, a myriad of reasons. And electric components have been able to win so many new customers because obviously they had to find someone else. They've Googled online, where can I find X widget? Electric components comes up, they've got a really strong digital offering, and they brought them into electric components fold. And then when they are confronted with a huge depth and breadth of range and the digital offering and the service, a led model, it's incredibly compelling, and therefore one would quite rightly question how many of these customers will go back to their niche mom and pop supplier. History shows, like in 2008, 2009, very few. And so electric components have done wonders for market share gains through this COVID period, and are now accelerating out and have come out the other side much stronger. And I think it's a great case of this corporate Darwinism point, that their business model today is in a far stronger position today than it was 15 months ago. Watch the Switzerland, a reseller of luxury watches, very heavily exposed to airports, so they had a big problem with many of their key units closed and still closed, which didn't really have much in the way of online sales. Is ultimately they changed the business model. They did a whole load of digital clienteling, where ultimately they have a loyal customer base. And bear in mind that roughly 30% of their watches are already sold at the start of the year, unlike any other retailer, based on lead times and wait lists. They're able to engage in their customer base and show them new models and sell watches they make a sell through online by doing display, and then people go and pick up in store, and end up having an incredible year with 3 massive upgrades in calendar Q4 of last year. But the key point I'm making is there are a myriad luxury watchmakers in the West End of London, but very few of them have digital capabilities. And so my point being is that the relationship between this oligopoly of watchmakers, notably Rolex, and Watches of Switzerland as a route to market, a supplier, sits between them and the end customer, has got much stronger, because clearly Rolex will see Watches of Switzerland now as an even more valuable route to market. And that's very important when it comes to getting what every retailer wants, which is exclusive content or more content, more share of Rolex's wallet. And it's very important also when it comes to expansion, if you've got Rolex behind you. And so the market position of Watches of Switzerland today, in my opinion, or the team's opinion, is far stronger than it was. We thought it's a great company. We backed the company at IPOs. We've owned it for a number of years, but we think it's in a far stronger position today than it was pre-COVID. And there are many examples of this. So why I think these things are so important. And then when you augment that with just lots of idiosyncratic risks, whether it's a Games Workshop or something else in the fund, that is why I'm so excited. And ultimately, That is what's important and will drive returns of this fund. It's not about monetary policy factors. It's not about, the exchange rate. It's not about the yield curve. It's around multiple battles being fought at the micro level in market share or the large secular trends that I have spoken to. And that is why I'm so excited. And that will be, as it always has been, the driver of returns of this fund, and will explain the good years and the bad years. And with that, I'm going to stop and will very happily engage and answer any questions that you may have. Thank you.
Thanks very much for that, Dan. Quick question here on the number of companies in the portfolio. You've got over 100 companies, and the questioner is just wondering if you've looked at whether it might be you could improve returns even further by concentrating further, if you've done any sort of analytics around that, or if you prefer to have the broad base underlying it.
Yeah, that's a really good question. And that is definitely one angle to pursue, to think about. Or maybe there's another question behind it, that just being too polite, but another question that I've been asked on a similar vein, I'm going to answer both of them at the same time just to humour you, is, oh, Dan, the way you talk sometimes, like, you're a really high conviction investor, but you've got like 100 shares in the fund, so like, what's going on? Like, and I'll answer both of them. Have we done analysis of having a more concentrated fund? Of course we have. I'm not, complacent. I want to deliver the best risk-adjusted returns for you as possible. The tail, because it's not a tail. The tail is not negative to alpha. It's highly, it's a big driver. Like all these things, though, without being flippant, if you told me at the start of the year, right, these are the 30 shares that are going to really deliver for you, I'd own those 30 shares and nothing else. But this is the great thing about the universe, is that I don't know. I love all my children equally. They're all great investments. They all have their own different risk profiles, own different valuation profiles. Some will do amazingly well and some won't. We make mistakes. And by the way, when we make mistakes, when you make a mistake in small mid caps with liquidity, and often the miss in profits can be large, and the derating on top, you can lose 50% very, very quickly. So what I've proved year after year, you can deliver phenomenal returns in this space without having to have a 20-share portfolio. Because there's so much return potential in the asset class. This is one of the great attractions of investing in small mid caps. If you invest in an asset class where there's like loads of mean reversion, because the dispersion returns, the FTSE 100 is way less than the small mid cap. If you want to get any decent return, you're going to have to like go big on gross leverage, or have very big weights and be right. Okay. And you don't need to do that in this world. And that is a very, very important and attractive environment. And what I like is every single year, my returns are always driven by a combination of some of my biggest holdings going up 30, 40%, and then a couple of smaller holdings going up 100 or 200 or 300. And this is the thing, that I obsess about how much money I can lose, and everything is calibrated. My top 10 aren't always my highest conviction ideas. I know it sounds weird. Many of my highest conviction ideas have never been a top 10. It may be due to their market cap. It may be due to liquidity. It may be due to the valuation. It may be due to the business risk. And so there's a lot of thought that goes into how I size holdings. And that's a very important reason for me. So I actually want to have 50 basis points in something, because I think I can make 10 times my money. But conversely, I could easily lose 25 basis points if it goes wrong. And that's why I want to own it and not miss out on that, but I don't want to make it too big. And that's how I've ended up with this broad, long book of 100 shares. But it's a tried and tested method, and it works, and it massively reduces volatility. And everyone thinks about, oh yeah, but in some years you could have made more, and it is true. But I often forget that in some years I could have lost a lot more.
Thanks for that. I mean, obviously, you mentioned the breadth of opportunity in the UK small cap space. What drives the overseas exposure when you include them?
Yeah, look, I mean, it's much more the US. It's much more on that philosophy slide about the great quality companies and the industry change. It's much more in the right-hand area of our industry change. The there are some phenomenally exciting leading in, I mean, look, let's use one example. I've owned this company for a number of years, and I've spoken about it many, many times. It's Xero, spelled with an X, and it was born in New Zealand, born in the cloud by Rod Drury, who saw how distribution of software was changing very, very early, and he realised that in the world of accounting, the only thing that's really changed is the principles had stayed completely the same, but he'd gone from a world of pen and paper to spreadsheets to seed-in-a-box software, and ultimately distribution and manufacturing software is going to completely change through the cloud, and ultimately he saw Xero as the way forward, and he's been proved completely right. It's now listed in Australia, and if you want to understand Sage, a listed company in the FTSE 100, you cannot possibly form any view on Sage without understanding two other companies. One is called Intuit in the US, a very, very big company, which you all know through QuickBooks online. And the other company you have to have an understanding about is Xero. And we did a lot of work on Xero, and we thought, oh my God, the opportunity for Xero is enormous, because the penetration of cloud software in the accounting channel is so low. The product is so compelling. It makes life so much easier for end customer and for accountant. It's a subscription model, so it completely undermines the price architecture of the legacy incumbents who have a high upfront license and maintenance. And the opportunity and runway of growth is enormous. And it's been an incredible investment over a number of years. And there are many other examples of that through the fund, where analysis on UK shares or industry trends, we can find better shares or different shares, or where we can gain exposure to something which we can't gain in our world. And that's why I love that 15% flex to do that. And you can see the returns of the international investments have been very additive to performance over the last few years.
I mean, obviously, you've stressed throughout that important free cash flow and financial stability and strength on the balance sheet. Would you look at companies which are really early stage, which are sort of almost pre-cash flow, if you think the upside's there?
Good question. There's always a case-by-case basis. Now, there is one obvious example where profits are not applicable, but cash flow is, and that's software. Because often software, because of the contractual terms of a subscription-based model, as you sign a 3-year contract, you get the cash up front, great, but actually you crystallize all the cost of that sale. And so as you grow, it's bad for profits and good for cash flow. So I raise that. It's not exactly what you asked, but I was thinking about it in light of the panel earlier on. But that is one area where conventional metrics like price earnings ratios are irrelevant in analysing a successful software model. It's utterly irrelevant. You're not making any money in software if you do that. You've got to look at other metrics, which is around EV sales, and much more importantly, the lifetime value versus the cost of customer acquisition. Okay, so that is one example where we follow the cash and the billings, and we don't look at the profits in the near term are irrelevant. In terms of another company that is generating no cash, it all depends what it is. There might always be one or two exceptions, but generally, like Georgina Bitter said earlier on, I don't get into real small stuff. It's basically more mid cap, larger small cap, where it's proven, and you don't have to be in at day one. There's so many companies that have made 10 times, 15 times their money. And I may have missed out on the first 10 times, but ultimately the market cap name was so small and irrelevant, it doesn't really count. It's fine if you're PA, but it's no good in a £850 million investment trust. You don't have to be first all the time. I want to buy something where it's liquid. I know what potential I have in the company. I know that if I get it wrong, I want to sell. Can I sell? These are all things that form my opinion. But if I did that, it would have to be on a very select basis. I'd have to have real conviction in the management team, the product, the end opportunity, and to believe they can finance their growth, or am I constantly having to be cool to give them more? It all depends on the financial structure of the company. So it's very hard, but it's possible. But generally, it's not what I'm interested in.
Sure. You mentioned earlier that you took down quite a lot of your shorting exposure last year because you didn't want to have too much into general market recovery.
Yeah.
Now, obviously we're expected to see some government support roll off later in this year. And is that increasing the opportunities that you think that some of the financially weaker companies will become a bit more apparent?
Yeah, yeah. The shorting's been very difficult over the last 40 months. That's not a surprise. I mean, you find anyone made a lot of money shorting in 2009. But you find a lot of people who made a lot of money shorting from 2010 onwards. You cannot, not any reader or listener is suggesting this, but one cannot extrapolate the last 14 months into the next 5 years. You've seen this huge recovery, which is to be expected. I mean, the stock market did fall 45%. And the UK has been a huge laggard because it doesn't have many of the companies that the US has had that have been able to thrive through COVID. It's actually one of the rare occurrences where small mid caps have outperformed large caps in a very difficult year, which is contrary, and it's ultimately because there were so many small caps that could do great things. There was some recovery potential, and generally in a recovery, a rising tide lifts all boats, and generally you have this dash for trash, or people buy the shares that have fallen the most and the most leveraged, etc. And you saw that all catalysed post the vaccine, and that's why value has had its day over the last 6-7 months. Despite that, trust is still doing great, absolute relative terms, and many of my growth shares have hit all-time highs, but ultimately I've had that backdrop to contend with. Shorting's about to get a lot more interesting. And the main reason for it is because the valuations of some of these shorts now are just ridiculous. They've moved so far, and none of the pressures have gone away. Consumers are still voting with their feet for some consumer-facing companies. Enterprises are voting with their feet. New competition is coming in. Supply is quickly coming back on stream. And that is a massive problem for certain industries. And, many of them still have the wrong share count. And so more value destruction will be locked in. But yet everyone's sort of anchored to some historical share price. Oh, it used to be at £6 and now it's only £3. I was like, who cares? The share count's wrong and the earnings are being decimated and they aren't going back and they're having to sell off their stuff to survive. So this is great. And if you had a profit warning in the last 12 months, no one cared. It's all changing in the last few weeks. There are some companies out there, bad companies, delivering now bad updates, and they are falling. And everyone's like, whoa, I've sort of ridden my luck here. They're panicking out of them. And so I think that we've endured this. And I think this headwind for me is going to come in a big tailwind. I think going forward, you're going to see now the start of a new era where you'll see a great dispersion of returns between winners and losers as opposed to rising tide lifting all boats. I think the tide's about to fall, and the whole Warren Buffett thing, we're about to find a whole load of people aren't only wearing any swimming trunks. Meanwhile, some amazing companies and little tugboats are just going to gently motor off into richer shores. So I think it's an exciting time coming, and expect, famous last words, everything's subject to change, but the way I'm thinking right now is that you should expect, because I'm thinking this is going to happen, that I'm going to start to add more shorts in the coming days and weeks.
I mean, the other side of dispersion, lack of dispersion on the way up, was there wasn't much dispersion on the way down in Q1 2020 and the initial sort of sell-off. How did you find that the short book? I mean, obviously, the short book will have contributed just because you're short in a market where everyone's falling. But what was the dispersion like in returns between your shorts and longs at that time?
Oh, well, you're absolutely right. In the very early stages of, we've all forgotten this now because it's like pain. When you have an earache or you break a bone, it's very, very painful, and you just can't remember the pain as time passes. It was horrendous in the initial stages. I mean, 1 minute, I'm getting a phone call basically saying that the nation's going to lockdown, and by the way, you need to pack up your box and go home. The whole thing was so surreal. So everything falls, almost regardless if you're a bank or technology company. That is to be expected. But that didn't last that long. I mean, very quickly, and actually people started to think, well, actually, Netflix might do all right out of this, and, Gamma Communications actually might do quite well because people actually may want to, oh my God, realise that they need to, invest in digital telephony if everyone's going to work from home. Suddenly people think, oh, Games Workshop, people might still want to, buy a product and paint it. And very quickly, some people start thinking, well, actually, like, could be quite good for this company, for this industry, and this company might take more market share, and suddenly, fundamentals reassert themselves. But in those initial stages, the short book collapsed, and we quickly locked it in. And I think last year, I've forgotten the exact numbers now, but I think the short book probably made over 2%, which is quite a big number for quite a small portion of capital. So the return on investment of that short book last year was incredible, and probably never to be repeated, or certainly in the next few years. And then the key thing is we locked it in. Like, it was a big call at the time. It all looks wise with hindsight, but I remember at the time telling everyone, by the way, I'm taking that up, in like April, and people were like, oh my god, like the stock market's down 38%. Like, how can you do that? Like, it's so uncertain. It's a big call to do things like that. But we ultimately thought that, like, we've got to lock this in. Banks are not, people are not breaching covenants. Everyone's been able to raise money. Life will resume. Some companies are doing well. The stock market will recover. And I don't want to get caught in a 2009 event. And I always know that when you get a sharp recovery, it's never my stuff that leads it. I'm always fighting that tide. And so I didn't want to then lose a load of money and sort of like unwind all the paper gains I'd made. So it was very important to crystallize it. And that's what we did. And then obviously the long book has driven all the performance pretty much from April onwards.
Okay. Question coming in about ESG filters. If you use any of those, either quantitative or if they're more qualitative.
No, we don't use any filters, but we take ESG. I'm not to say this. I take ESG really seriously. We always have. Like, you're talking to someone who's been this whole time telling you how important like management teams are and governance and who's actually running divisions and geographies. And we want to own companies that can go up many, many, many times. And generally, that does come down to many of the things that ESG look for. Obviously, there's some other things that we have to focus on now, more importantly. You're also speaking to someone who doesn't own a single mining company or single oil company. So generally, the industries that I'm exposed to are much positively biased toward, not biased, but they lend themselves much more favourably to an ESG screen. We have a huge stewardship team at BlackRock. We are very heavily engaged in many companies for corporate governance, but also on how they can improve disclosure and how they can improve all parts of ESG. And so we continue to engage with those companies. But it's a really important part. I mean, it's not a coincidence that my second biggest holding is Impact Asset Management. The whole asset management firm is built on ESG. That is their DNA. That is what they defines them and differentiates them from everyone else. And they're damn good at it. And they have an incredible track record of performance. And they've seen incredible flows. And the growth in AUM that company has seen has been breathtaking. And I take it really seriously as an investor, but I also see it as a huge growth area and one that thankfully we've monetized through impacts. But there is no filter, but it's very intertwined in the analysis we do on all our companies.
I mean, your marketing department has just sent me an email and asked if you could stop being nice to other asset managers. But,
yeah, fair enough.
Okay, I think we're pretty much out of time. I think we've got a minute left, so I don't know if there's any sort of closing roundup you want statement for yourself. But I mean, I think it covers on your slide. But anything last words?
No, look, thanks for your interest. I hope you found this of interest. My personality doesn't appeal to everyone, and I'm always being told by my wife to apologise to everyone that I haven't yet to offend. But for those that are still with me, thanks very much. For those that invested, obviously a huge thank you. I genuinely, massively appreciative for those that have backed this trust, and I hope that you are happy. And I say it with utter sincerity that I am an optimistic, positive person for all reasons to discuss, but I really think the opportunity set is incredibly compelling. And that says nothing about what performance is going to be like in the next 1 week, 3 weeks, or 3 months. And to be honest, I don't really care. What I care and really care about is like what these shares are going to deliver over the medium to long term, because that is where you make and drive serious shareholder value, and that is why I'm so excited. Thanks very much.
Great. Thanks very much for that, Dan. Thank you to everybody for joining. Encourage you to stick around for, I think it's Judith McKenzie with Downing Strategic Microcap next. But thanks again. Cheers.
See ya.